Next question from Scott. Markets were previously making new lows on the thought of the Fed making a rate rise. Markets are now making new highs on the back of the Fed saying they will raise rates. Any idea what's going on here? Definitely have a lot of ideas of what's going on there. And the number one thing we're sort of gathering from consensus and in meetings is that people still think that the Fed, people are trustworthy of the Fed's forecast, if only because they don't do macro themselves. They don't think about macro. So we have a chart in our macro themes deck, slide 47, I believe, that shows the 2016 Bloomberg consensus GDP estimate for every G20 economy. And then we show that on a percentile basis relative to the trailing 10-year sample, the trailing 10-year growth rates of those economies, those respective economies. And what you see on the far right of the chart is the US up in the 83rd percentile. So basically people expect, there we go, the chart here. Basically what we're showing is that the consensus expects a broad economic recovery in the US. They expect a broad earnings recovery in the US. And that's because A, that's what the Fed's dots in their forecasts imply. And B, that's what economists and sort of even sell-side analysts are expecting. So the Fed raises rates, this is just normal. This is mid-cycle. You got to flow money out of bonds. Bonds have obviously been sort of big winners in the fund flow debate in the sort of post-crisis era. You flow money out of bonds, you flow money into stocks, it's mid-cycle, everything's great. We've had a little soft patch here, but we're up and off to the races. So I think that makes perfect sense. The flip side with markets trading in line with good is good and bad is bad is that if the data is bad, the markets could go down on that. So that's, you can't have it and win in both ways. We tell people this all the time. What if that chart is wrong? What if those estimates are wrong? What if the bottom-up earnings estimates for 2016 EPS recovery are dead wrong? What if the Fed and consensus forecast for US GDP growth recovery in 2016 are dead wrong? Does bad become bad? What if Hedgeye is right and the US economy slows into an eventual recession, sometime by the mid to late next year? What if bad becomes really bad? Certainly with the lack of liquidity across fixed income, sort of particularly credit and equity markets, I don't want to really test that. I think it'd be better for our business to not be too right. But again, we're just going where the data lies. We don't have an agenda here.